This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.
Thank you, everyone, for joining today. This is Tax Records, the podcast series produced by the Hall & Wilcox tax team. My name is Frank Hinopoulos, and I'm a partner in the tax team. And today I'm delighted to be joined by my colleague, Special Counsel Adam Demack, and newly minted as Special Counsel as at 1 July. And today we are going to be talking about the one of the hot topics at the moment, and that's cryptocurrency. And this has been a recurring theme in all of our Tax Records podcasts. So, Adam, this is our third crypto NFT podcast. And in the previous sessions, we covered the Tax 101 basics of cryptocurrency. In this session, you and I are going to speak about some hot crypto NFT tax topics. Before we get down to that, though, Adam, I think we all know that crypto has been in a bit of a bear market. I hope you haven't invested your life savings and house deposit in crypto, or maybe you have. But do you have any tips for our listeners about how to manage this current bear market in crypto?
Yeah, thanks, Frank. Thanks for the intro. I certainly have invested, and let's just say I'll be at Hall & Wilcox for a little while yet.
Good. Well, that's good. I just promoted you, so that helps. Yeah,
works out well, doesn't it? Look, I can't. I'm just a mere tax lawyer. I can't give any financial advice. But when the crypto markets first tanked, I think back in 2018, I had some investments at the time as well. Basically what I just did was I just didn't look at my portfolio or my accounts for 18 months and waited for the markets to come good again. And it all worked out fine. So definitely not financial or legal advice, but maybe some emotional help for people who have invested out there.
I think the old investing adage, when you're wrong, go long. I certainly understand that well. So, Adam, speaking of losses, and maybe there are a lot of people who have invested in cryptocurrencies more recently and are staring down some capital losses. We did see a spate of messages around the end of financial year, as we very often do in the newspapers and so on, encouraging opportunities for taxpayers to realise losses on their CGT assets prior to 30 June. That applies to all investments. Could you talk a little bit about how this works in the crypto NFT world, and what some of the risks around a strategy like that might be?
Yeah, I recall seeing the same sort of messages as well. I think at least in a few prominent newspapers, and if not on TV as well. And I think one of the ATO's assistant commissioners also put out some publications about it. I mean, look, as you'd know, realizing a loss on a CGT asset doesn't on its own really present any tax risks. That's something that taxpayers are entitled to do, and that's just a reflection of financial and economic and commercial realities. But when you realize that loss in combination with the repurchase of the same or substantially similar assets, what you do risk falling foul of is the Part 4A general anti-avoidance provisions. And these type of schemes are commonly referred to as wash sales. And since about 2008, the Commissioner has held the view that the general anti-avoidance provisions can apply to wash sales and different variations of it. Now, wash sales will usually involve, or can involve any type of asset, but for practical reasons, will usually involve assets that are fungible and interchangeable. So traditionally, shares have been the big one. More recently, though, we've got cryptocurrency. And the reason that wash sales and cryptocurrency work particularly well together is because the cryptocurrency transaction costs are so low and the transaction times are so fast. So, you could imagine someone who, for example, sold every last bit of their Ethereum on 30 June. And even if they sold millions of dollars worth, their transaction costs might be pretty low. And then the first thing on the morning of 1 July, they just go and buy back all of that Ethereum, the exact same amount. And subject to any market movements over those few hours, they'd basically be in the same economic position, but might have realized a very substantial loss on that sale. So that's why wash sales are particularly prominent and have, at least anecdotally, in what I have been hearing, been discussed pretty widely in the cryptocurrency community.
Excellent. Thanks, Adam. No, we wash sales have been around for some time, and as has the ATO's views about wash sales and the potential for Part 4A applying to them. And we should remind our listeners that when it does come to Part 4A, that the Commissioner does have quite an extended amendment limitation period of up to 6 years to reassess a taxpayer. And can you just talk to any practical experience that you've had? I mean, one of the things that we hear a lot about in the press and that we see in our practice as well is just the ATO's ability to detect some of these cryptocurrency transactions, and there's possibly a sort of sense of security that the crypto part means that these transactions may not be as discoverable as transactions in the usual tangible world or the ASX may necessarily be. Have you had examples of clients of ours or taxpayers who have been picked up by the ATO through data matching and so on?
Oh, yeah, absolutely. I think we spoke about this in the first podcast, but I'm glad you asked the question, because if there's one thing that I'd like to sort of stress and repeat as much as possible is that the idea that, cryptocurrency and NFT trading is not transparent couldn't be further from the truth. Really, it's an asset class where perhaps more than any other asset class, the Commissioner has a very good ability to perceive what taxpayers have been doing. In terms of examples, yeah, I mean, I personally have every single year received some form of correspondence from the Commissioner to remind me to properly return all of my cryptocurrency gains and losses. I have examples of clients who have, I'll say attempted to do it, but understandably got mixed up and lost in the various spider web of transactions and different accounts that they're using and the various trading that they're doing, and not really done a thorough job. And in those situations, I've seen examples of the Commissioner contacting those taxpayers to basically to prompt them about whether they think they have properly returned all of their cryptocurrency trading and transactions. And I think, just to repeat something I said in the first podcast, the reality is that when you sign up to a cryptocurrency exchange in Australia, you're required to provide them with a huge amount of information so they can meet their regulatory requirements. You have to give them your driver's license, name. Sometimes you have to film yourself with your driver's license. And all of these Australian cryptocurrency exchanges are subject to the Commissioner's information gathering power. So with that information, the Commissioner can basically go and search a blockchain with the wallet address that's linked to your identity and really just see every single transaction that you've ever been involved in quite easily.
Terrific. Now, Adam, one of the topics that we've been hearing about recently quite a lot is DeFi. So I'd like you to do two things if you can, please. The first is, could you explain what DeFi is and explain it to me like I was an 8-year-old? And then can you talk a little bit about some of the basic tax issues that arise in connection with DeFi?
Yeah, sure. Yeah, decentralized finance is probably, and I've been saying it for a while now, it's probably, in my eyes, really the next big thing in the blockchain world. We obviously have NFTs, but DeFi is absolutely massive. Well, you can probably jump on Google and go to a webpage like Investopia, which I've got in front of me, and it explains that DeFi, or it defines DeFi as financial technology based on secure distributed ledgers similar to those used by cryptocurrencies. And basically, it's a pretty broad topic, and it can include anything that involves financial transactions that are facilitated on a blockchain or distributed ledger. So you've got, your usual financial transactions like peer-to-peer transactions, cryptocurrency exchanges. You've got this thing called yield farming, which at best I could stumble through in trying to explain on this podcast, and I'd probably take up half an hour. And I think that most of our listeners would probably think I was talking about a Ponzi scheme. Then we've got probably the most common example of DeFi, which is the one that I think we should probably focus on for the rest of our discussion, and that's lending. And basically that captures protocols or programs where people can lend their cryptocurrency just like money, but it's all decentralized. And rather than getting interest in the form of cash, taxpayers will receive interest in the form of a native cryptocurrency to that platform.
Excellent. So for people who are involved in these DeFi transactions, what are some of the tax implications that they have to watch out for?
Yeah, there are probably a few layers to that question. I think the most simple one is, and probably the first question that comes to mind for most people, is how are your gains taxed? So how is your interest from decentralized finance lending taxed? For most taxpayers, I think that interest component would simply be taxable as ordinary income, just like your interest on a normal loan. The difference being that it would be the money or market value worth of the cryptocurrency that you receive that's going to be included in your assessable income. And that will usually, for most taxpayers, then become the cost base of that cryptocurrency in their hands. That sort of leads us to the next tax question, and possibly quite a big tax issue as well, which is how are losses dealt with? And there are a few different forms that losses might take in decentralized finance lending, but probably the one that is most sort of exciting to talk about is to imagine a scenario where a taxpayer receives cryptocurrency as an interest payment. They include that in their assessable income, and then there's a huge drop in the market value of that cryptocurrency. The taxpayer sells that cryptocurrency, and if they're holding that cryptocurrency on capital account, as many taxpayers are, they're left with a capital loss. So they've had to include a huge amount in their assessable income. There's been a price drop, and they're left with a big capital loss. And that's a real issue. It's a relevant issue. It's happened to taxpayers out there, but it's probably not the biggest issue in terms of decentralized finance lending. The big issue is simply what happens when you enter into these decentralized finance lending arrangements. A typical lawyer answer is it depends. It depends on what protocol you're using. It depends on what program you're using. But there is certainly a risk that some of these protocols basically result in a disposal event for CGT purposes. And so you might have taxpayers who have unwittingly entered into a huge amount of these decentralized finance lending arrangements. And every time they've done so, they've triggered a CGT event A1. They might have triggered a capital gain, but it won't be funded with cash, or they might have even triggered a capital loss.
Right. So sounds like the old world concepts of loans and so on and interest apply equally in this more high-tech iteration of DeFi. So thanks for that fantastic response, Adam. And again, just throwing a little bit of jargon at you, the other thing that I've heard a lot about and haven't really taken the time to understand so well is staking. And again, could you just explain what that is, and is it something similar to DeFi in terms of the tax outcomes that we can expect?
Yeah. So staking refers to like a consensus mechanism as a means to ensure that transactions are verified on a blockchain, and your cryptocurrency can be part of that process. Maybe to like give it a very basic explanation, which is how I like to think about it personally, it basically involves like locking up your cryptocurrency for the purpose of use of the verification process. So to verify all of the other transactions on the blockchain. And in return for locking up your cryptocurrency to allow that to happen, you get a reward. Now, not all cryptocurrency blockchains are verified using staking, but some are, and many are moving towards that method of verification for various reasons. Now, it's similar to DeFi in the sense that the rewards that you receive for staking your cryptocurrency, they're not going to be cash. They're generally going to be an amount of the underlying or native cryptocurrency. Now, you can jump on the ATO's website guidance, and they helpfully have some guidance on staking. And the ATO website takes the view that the staking rewards are ordinary income. You need to include the market value at the time that you receive it in your assessable income. And then that market value would also become the asset's cost base for CGT purposes. And I think that's a pretty sound position from the ATO. Staking is in some senses a bit like lending. You're putting forward some form of capital and getting a reward from the use of that capital. But you can probably immediately see that the outcomes for staking, or the tax outcomes for staking, and the potential anomalies are quite similar to DeFi. So you might imagine a situation where you stake some of your cryptocurrency, you get a reward, you include the market value of that cryptocurrency in your assessable income, but then the prices tank and you have to realize a capital loss. And that's obviously a very topical sort of outcome at the moment with the current market that we have. Probably to a lesser degree, you need to be aware of whether staking protocols can lead to a disposal for tax purposes. I think for the most part that won't be the case, but it pays to be careful. For those taxpayers who are sitting on massive unrealized gains, you would want to be quite careful about whether the transactions you are entering into will trigger a disposal and a potential large tax bill.
Excellent. Thank you, Adam. And once again, we really appreciate you presenting on the topic of cryptocurrency. You've got a real knack, I think, for taking the complexity and breaking it down and making it understandable, and then giving our listeners some little nuggets that they can take away and help them in their practice. So thank you once again for presenting on this topic, and thank you to our listeners for listening to today's podcast. We trust that the information today has been useful, and as always, please get in touch with anybody in the team if there's any aspect that you would like to talk about further. You can find all of our details on our website, which is www.hallandwilcox.com.au, or you can connect with Hall & Wilcox or the tax team through LinkedIn. And if you enjoyed today's episode, and you no doubt have, then we would be most obliged if you could rate, review, and follow our podcasts wherever it is that you listen to your podcasts. You can also subscribe on our website to be notified of new episodes. So thank you, Adam. Thank you to our listeners, and we'll talk next time.